Hello folks, this is Michael Huddleston with a Pro Traders Club entry for September 17th, 2012. Alright, we're looking at the dollar index. This is the daily on the left hand side, and we have a 15-minute chart on the right. Okay, we have price coming down to these levels here we've noted for possible downside objectives. And that is seen over here as well. And while we have more or less a consolidation sideways, which is more or less what you would expect after a very steep decline like this. Traders are taking inventory as to what may be the next swing, and I suggested that we would possibly consolidate and maybe even trade back up into some old highs in here as short-term support, broken turn resistance. Obviously, if we continue to break down, we would run this old low here, and then the 62% retracement level on the larger dominant price swing from this low to this high. In this area here, optimal trade entry would be suggested downside objectives. We've seen a higher high in today's New York session in the dollar, and we're going to talk about that in relationship to the fiber and the cable, because that did set up a nice little signal that you could have participated in. Obviously, we favored still the downside on the short-term momentum. Everything still is suggested bearish. Just because we get to old levels like this doesn't mean we're going to turn on a dime and then bounce straight up or even consolidate sideways. We just never know that. We are in an area where there has been congestion, so I suggested a small short-term consolidation, maybe another bear flag, would be out of the question. But I still would like to see another bounce up, even if we do trade lower. It would just give another opportunity to get some kind of a short-term trade. But you got to give whatever the market gives you. So we had price trade up out of the Asian range in the dollar, and more or less it was a false break above London Open's highs in here on New York, and it came all the way down, blew out the stops below Asian range low, and then back in consolidation ran the highs on New York. So it's been a rather sloppy day. This would be like a Z day profile where it's just more or less up, down, and it consolidates back to the middle. Okay, and the way that works is if you take the high and the low into that midpoint in here, 78.85 was the midpoint, or is this equilibrium. Okay, and the same thing could be arrived at by using the previous smaller dealing range in here. So this down move to here, you get 78.85 in here as well on that 50 level. Okay, so that's how you arrive at equilibrium. And when you have a Z day, you more or less sell rallies and fade declines, and more or less just look for very short-term scalps. If you're absolutely hardcore trader and you need to be in there doing something, I'm just not that type of trader, but used to be, been there, done that, and it burns you out quick unless you just are really built that way and wired that way. I'm just not. So we're going to focus on this point in here, the London Open and New York Open turning points that we always monitor. And let's segue right on over to okay, we are looking at the Euro USD fiber pair, and on the left hand side we have the daily chart. Note the high here down to the low. We are inside of optimal trade entry. We are in a very aggressive retracement in this dynamic decline here. This is the most prominent price swing lower. Now, this, to me, if we get above this, obviously the 90 level would be here around the 133.50 level. If we do move higher, which I'd be very impressed to see that, because I mean we are so aggressively one-sided here on the fiber. The next short-term highs in here would be upside objectives. In this case, this comes in at around 132.80, and the next one here at 133.67, or basically 133.12. And then we have highs up here at around the 134.80 level as well. So we still have a few little upside objectives, but for us to get up in there, um, you know, that remains to be seen. I would like to see a retracement, but obviously if we fall all the way back and maybe even retest these highs in here, that may be just a little bit too much. But we'll see. Looking at price action today, we saw the Asian range in here. The initial move out in London, down, ran up back into the Asian range again, and then once again blew out the low that was made in London. So stops would have been taken here. And now I want to draw your attention to another example of market structure where we could take. Now the question is why do I pick the specific points in my Fibonacci tool application? Okay, it just looks like I'm indiscriminately just reaching for the best points. Okay, now I'm going to repeat this, and you need to put this in your notepad. What? A notepad? If you don't have a notepad and you're watching my videos, you are wasting your time. You're never going to remember this stuff. Okay, so you need to have it to pen and paper. All right, I do it. It's how I learned. I'm sure everybody that's successful has a pad and pen. You have to take notes, guys. Okay, otherwise you're never going to learn. Okay, so it just boils down to that. I want to draw your attention to the session highs and session lows. Okay, again, go back to the trading the key support resistance level module that was 2 years ago, guys. Okay, I know it's old hat, but it's good stuff. Okay, so the best stuff is the most bland, basic stuff. I know you're impressed with all the wizardry with the little things I've been recently showing you, but you got to build it all on the foundation of support and resistance. And one of the key principles of support and resistance, at least on the intraday, is your session highs and lows. That means the highest high and lowest low of Asia, the highest high and lowest low of London, the highest high and lowest low of New York, and obviously London close and New York close. So note this high here. Okay, this high right in here. This is a high in London open. This right here is a low in London open. So this is the highest high and the lowest low in London open. Okay, so either one of these points would be good reference points to pull a fib from. Okay, look at this low in here. This is New York open, 12:15 GMT. That's New York. You have a 11 GMT, which is kind of early New York, but still, nonetheless, it could be utilized. This high in here is 14 GMT. That's the last window hour of our New York open kill zone. Okay, that's a good reference point to use as well. This low here is 17:15. Okay, that's still London close. That's a nice point to pull your fib from. Okay. Over here, same thing. We have the 8:45 GMT, London open. This low in here, we have 12 exactly to the dot GMT. That's New York open. The high here, 13:30 GMT, still within New York open. Okay, so we have these 2 points in here that could be referenced for a nice Fibonacci application. Now we're going to introduce again the concept of using the mid figure and big figure. Okay, in other words, the 100 levels and the 50 levels. Okay, now look at the range low here to high. Okay, you see that? Then you see this high in here. Look what that lays with. What do you see over here? 130.50. Okay, you have 130.50. So if price breaks through a mid figure like this and runs up, okay, and starts to pull back and then consolidates and then trades back off, okay, what is the range? Think about that for a second. What is the range at this point right in here? What is the larger dominant dealing range that price is working within. Is it this one here to here? Or how about this one? Here to here? Or is it this one? That mid figure, old high, support, psychological. We moved away from a mid figure. Okay, and then there's your range. Okay, here's your inside the range concept. Okay, now watch what happens. This is the range that we are working within in Asian range here on today. Alright, now watch what happens. If I take and now apply another one of our tools to utilize support and resistance. Okay, now this is going to be an implied support and resistance concept, but nonetheless it's what we use for support and resistance. And there we go. Alright, so we have the Asian range high in here, the Asian range low. Okay, we have price trading down to S3. Here's S2. Here's S1. And this yellow level in here is the central pivot. Okay, now below the central pivot we are in the buy zone. Okay, this is the buy zone in here. So anything below the central pivot is a buy. Now add to that we still are relatively bullish. Okay, we could be still expecting to see upper movement in price. Just because we went back into this optimal trade entry retracement doesn't mean we can't trade further up. Okay, so the momentum still favors the upside. So any little short-term buy signal still will or should provide you an opportunity to get long. Okay, and pay you some pips. Now watch. We have our range here. We're within that range, okay, but now we're going into what? A kill zone. Okay, we're going into a kill zone. Let's now apply that range into the new day. What do you have here? And what do you have here? See that? You have the London Open coming out of Asian range. Okay. Now you could have bought this and used a 30 pip stop if you're buying at the 62% retracement level. With a 30 pip stop, your stop's down here at 130.65. Okay. So buying at 130.95 or maybe even buying 131 figure. Okay. Just making it easy for yourself. You could be positioned for a nice little short-term move today. But now watch this. We have the optimal trade entry sweet spot with the New York Open kill zone right on the very 12 o'clock hour GMT. Okay. We had lower lows at the same time. Remember, the dollar was making higher highs there. Okay, it's going to be an inverse relationship. By itself, this is pretty cool. Okay, you could have took that signal here and traded that. Average daily range. Fulfilled here at 131.64. So the ADR was 82 pips today, and we fulfilled it with 89 for a total range from low to high. Okay, so that was very handsome. Running to the previous day's high, which would be Friday in this case, ran right up to that and then retraced aggressively. Okay. Now I'm going to cover this why we retrace back in here again in a second. I'm going to go back to the dollar because I want to show you this price action before we go back to the dollar, and I'll close it. But this is a nice little opportunity in here. But now let's go and take a little deeper look at what this is giving us. So we had confirmation with lower low here in the fiber when the dollar was making a higher high between London Open and New York Open, New York went lower on fiber and dollar went higher in New York. In other words, this is relationship reversed. Okay, so the dollar would have had a higher high here. Okay, so just for simple sake, here it is again. Here's the dollar. We went higher. At the same time, the fiber went lower, but we still had opportunity to get a long in here based on a lot of our implied support resistance levels, kill zones, okay, and optimal trade entry. So there you have it. But now let's take a look at the cable. Okay, we are looking at the cable. All right, and I have this all lipsticked up because it makes it a lot easier for me to zip through it. We have the Asian range in here. Okay, here is a higher low in New York. These boxes represent, here's London Open, here's New York Open, here's London Close profit taking hour, 1500 to 1600 GMT, where we called the daily high or low to form. And you can see we did that again here today. Surprise, surprise. This level here is average daily range. Okay, I just have it noted here because I wasn't sure if I was going to get the recording done in time, but just for the sake of showing you completeness, there's the average daily range fulfilled here. And again, that came in at 162.68. The ADR for the cable today was 58 pips, and we went to 62 pips. Okay, so we did have a SMT divergence in here. All right. Note also, same thing here. We're going to use the same principles. All right. See this low here? That's 9 GMT. Okay, 9 GMT. This low here is 7:30 GMT. This low here is 6:15 GMT. Okay. Either of these in here could facilitate the fib tool from that because it's still a session low. Okay, the on the London Open session low on Friday. This high here, 1550 GMT, that's the London close time frame. Okay, there's your high and here's your low. This is the range that price was trading in during Asia. Okay, so watch what happens if we take the application of the fib again, place it on the low of London on Friday, the low on London, and the high on London close. There's your range. Okay, we have price come right down to that 62% retracement level. Okay, we were below the Asian range high, which is that filter we use. Same thing with the fiber. If you go back and look at it, it was below the Asian range high. Okay, now if we use the smaller intraday range price swing, we could see the 162.20 and then the 162.16, around 162.15 or so. That could be a very handsome opportunity to get long as your entry. With SMT divergence, it was basically giving you the heads up that, hey, look, something's up. This could be an intraday scalp, and you could run up to, again, Friday's high here. Okay, but the cable basically gave you the signal for the fiber. Okay, see how we had the lower low here in the fiber, while the cable was unwilling to go that lower low. Okay, so intraday we had an opportunity to get a good 50 pips from either one of these pairs. So again, we had the technicals line up with the utilization of correlated pairs, and then we saw upside objectives met intraday. And again, obviously, profit taking hour here, fulfilling what we usually look for the higher low to form in the day. Now, For you London closed traders, we don't really talk about that too much anymore, but you can see we did have a nice setup in here. Looking at the London close, average daily range was fulfilled. Optimal trade entry in here, 162.67, and even running back down here, taking out this low would be a good objective, and you can see that take place here. Price almost came back down to the Asian range high. Not quite, but nice little technical day. Even if it wasn't a huge range day, it still was presenting some opportunities to take some pips out of the market. So hopefully that was insightful to you. I did post a link to a live stream recording I did today, referring to, again, one other example of our tools and utilization with the Australian dollar. And a question came through the forums, why did I use a specific low in the Australian dollar in my example yesterday in the review. And I'm going to add that here with some lipstick and some things that I couldn't reply to the recording with live stream that I can do in my Cam Studio application, where I can put all the nice little highlights and draw your attention and bring in more graphics. So let's use this opportunity to segue into that and reveal what I was trying to more or less get across today in the recording. Okay, this is a video response for one of the viewers on our thread on baby pips. Their inquiry was, in my most recent market review, I elected to use a specific price low in the Australian dollar. The main point first I want to say is, number one, I'm not really an Australian dollar trader. I do like pointing out opportunities where the tools that I use work in other pairs, and I believe that the stuff that I use is universal. I've always maintained that thought process, and this is just an example of how it could be used. I did not trade this, obviously. I'm not about to say I took this trade, but we talked about the yields in the Aussie and the Kiwi, giving some indication that there was some bullishness earlier in summer, and it was a catalyst for upside movement. But we're going to talk about market structure and why I went to the low, and you'll see what I mean in a moment. If you don't know what I'm talking about now, reading, we'll pull up the post and you can see what I'm referring to. Please don't take this as an invitation to that I'm going to be giving a video response to every inquiry. Sometimes when I read something, I'm not skirting your inquiry. I'm not trying to ignore it. I just know that I have an answer for it and it's coming shortly. So I kind of want to more or less keep everything in one place. I know some of you guys get a little impatient, and that's normal, but I'm not going to speed up for your impatience, so please don't be offended by it. All right, before we go any further, this is the range. This is a daily chart on the Australian dollar, and this high back here is the February 29th high, and we're going to be looking at the range between that high and the low on June 1st, 2012. Okay, and we're going to draw a fib between that high and the low. Okay, and we have the 79% retracement level, sweet spot, and 62% retracement. So what we're going to do is we're going to draw lines on that to highlight, should price get to that point in the future, we would be very interested in these particular price levels. Okay, and now notice that the sweet spot happens to converge with this old high back in here, 104.73. Okay, so as the market has been trading lower, large institutions and funds will have trading stop losses right above these highs. Okay, and they'll allow the market to move rather sharply and move away from their resting stops. They don't trail stops ultra tight. They allow the market to move in their direction for a long period of time and then wait for a higher time frame reference points like this to trail their stops. As price gets down to this low here, okay, and then rallies back up above this high here, okay, notice prior to this there was no broken swing highs. Okay, this one here almost challenged this one, went lower, and then finally on this candle it broke this one. Okay, and on the very next candle it broke this high here. So we have market structure changing, and now market flow is now bullish because we broke a swing high. Downside momentum is now shifted to bullishness. Okay, and that change in market direction was indicated on the 6th of June. We consolidated bull flag and then took off. Now, as price was rallying up, there's two levels that would be of interest. But we have two legs in price here. We have this high down to this low, okay, and we have this high down to this low, okay. Look at the chart for a moment before I move any further, and hopefully you guys can see that. Okay, there's two legs in this large range from this high down to this low. So by breaking this larger range up into two smaller swings, okay, it goes without saying that there is a low here and a high here that's significant. Okay, this is how we use market structure. We have a down swing here and then another new downswing here. Both this swing low and this swing high are significant. Okay, they're used in projections from taking this high down to this low, subtracting it from this high down to this low. Okay, that's one way of using it for measured move analysis and looking for targets. But we also have this fib pulled from this high down to this low. We also can do the same thing here. Okay, so now we have a smaller range within the larger range. Okay, this is fractal analysis where you take a specific price swing or a pattern, okay, and you break it down into smaller pieces. Now in this larger price swing, we have a smaller price swing here. Note that we had the 79% retracement level here, 62, and the sweet spot in here at 102.10. Well, as price started to trade up, these levels are going to be obviously the first to expect upside resistance, if at all, before we get to these larger ones on the higher time frame swing here. See, this is the larger dominant price swing, this 108.53 to 95.82. That's the dominant price swing. But we have a more smaller magnitude price swing between 104.73 to that 95.82. Okay, so as price starts to trade, forward, look at the reaction we had here. Okay, went right up to that sweet spot and traded down. We have old highs back in here. Okay. And you get a reaction here. Okay, so we had this low in here to this high we could have used because we had bullishness when the market flow and market structure has shifted. Okay, so as price rallies up, if we expected some initial short-term resistance in here, this is going to be a pullback. Okay, it's going to be a counter trend trade, but it's going to be a pullback for another opportunity to get long based on this long-term price swing, broken now bullish market structure and market flow. Okay, so now watch what happens if you take the swing low in here to the swing high in here. Okay, watch what unfolds here. And let me take this fib. And I'm probably going to have to take that off. Alright, well we have 62 sweet spot right here on the low and then 79% retracement level. Okay, and then price reacts up, comes back down again. Look at a smaller time frame. You'll get optimal trade entry in here as well. In fact, look on the June 28th of 2012. You'll see optimal trade entry on that candle, and then you see price explode to the upside. Now, continuing with our example. Now, price runs right up into the 62 sweet spots here and 79% retracement up here. Again, retracement. Okay, let's take this off. Now, you see how price has broken market structure here, rallies up, pulls back, gives you an optimal trade entry here. Rallies up, pulls back, okay, again. What do you see here? See how that gives you a nice swing point to pull fib from? Optimal trade entry, sweet spot, rallies up again, and it retraces again. $79 retracement level, sweet spot, 62. Optimal trade entry, runs right up. Okay, so all we're doing is just using market structure to get in sync, okay, with the upside objectives that may be unfolding. Now here is why I chose this specific swing low that I mentioned in the most recent market review rather. Take a look at the low here up to this high. Okay, you see that? This is your first price leg up. See that? Price leg up. And we retrace, and then we start to rally up again. Based on the high to low, this is the optimal trade entry upside objective or retracement objective based on this higher time frame 108.53 to 95.82 level. So we have that range to be considered in terms of upside. We have these old highs back here as potential stop running objectives. So as price starts to run up, watch what we can do. We have this first initial leg up. If we take that and add it to this low here, okay, all I did was place it right on the low, this swing low, and this is the upside projection right up in here. Okay, so if price runs up to that point, right in here, here's your high. That's one price leg up, and then the second price leg up. Okay, so that's market structure, and that's the reason why. Okay, because the same thing we talked about here on the downside, this high down the low is the same thing as this high projected lower. You get this low in here. Well, the same thing we have here. We have this low up to this high is initial first price swing leg up, and then as we start to rally up again, we knew to expect upside objectives up here based on this point here. Once this high was taken out and swing high was broken and market flow and market structure is bullish here. If we do rally, we're going to be looking for this old high here and the retracement of this high down to the low, 79 and 62% retracement levels and sweet spot respectively. So we would expect price to get up to that point based on that first price leg here. And then as we retraced, it started to run up again. So this makes this a dominant price swing low. This is not to negate the fact that you could use this one and this one, okay? But if we start to see price break down, as we have here, by using this one, and let's do that. First of all, we used this low to high already, and we had this optimal trade entry, so it's already been expended here. Now it doesn't mean that you can't use it again in the future, but this is a smaller magnitude swing low.
or lesser in significance versus something like this, because this is a first price leg swing, then a low. Okay, then you have these smaller short-term lows. They're still tradable in the direction of the higher time frame premise, but they're not going to be as significant as if you look at the major swing low here up to the high. Okay, because we're measuring essentially the second leg. Here's the first leg from this low up to this high. Then you have this low up to the high. It's repeated. Okay, went right to the pip. So now as we expect to see price erode, if it's still ultimately bullish, okay, or if we expect some kind of bullishness, what would be the catalyst for that? As price is starting to retrace, we had the 62% retracement level, which almost lines up with this old low. The sweet spot 105, I'm sorry, 101.58, okay, and then we have the 79% retracement level down here at 101.15. Well, as price was rallying up, folks that are bullish and have been maintaining a long position in here, where's their stops going to be? Their stops are going to be resting underneath a significant price low. That's here. Okay. So as price starts to erode and starts to trade lower, here's the low. Let's take this off. We're going to put the line right on that actual low. And you can see it went right down to the optimal trade entry sweet spot. It gave you two candles, okay, two daily candles. It went below that just by a few pips, just to run out any stops. And I teach that before there's any significant price move that's aggressive, it's going to take place after a stop rate. And this is what you see here, okay? And then obviously price ran up. So where's it going to run? It's going to go back to where the old high or stops will be resting above here. And it went right above it by a few pips, and obviously we're off of it today. Again, I just threw this out there because I'm just looking at market structure. I'm not looking at it as a specific trade because I don't trade the Australian dollar. But hopefully that was an answer to your inquiry speculation, and that was for the baby pips post why I used this low versus something up in here or even this one down here. So hopefully that was insightful to you, and I wish you good luck and good trading.